am Nongcebo Vukile McKenzie, and this is the podcast, Sawubona. Every fortnight, a guest joins us for a conversation or to share a story. It's a pleasure to share these with you and to have you with us. Welcome, Ngiyakwamukela, to another episode of Nongcebo McKenzie, the podcast. Over the past few episodes, we've been having conversations with the Momentum corporate team as part of the Zenzele series, really looking at planning for your retirement better so you can retire comfortably. Now, we looked at it from a savings point of view, the importance of savings. We looked at it from a debt point of view, getting rid of your debt so you can save more, and that will then help you in terms of planning for your retirement as well. We then looked at Two-Pot. We know Two-Pot kicked in September 2024. There was a lot of change that came with it. What are the implications of Two-Pot overall? But then we really looked at your Two-Pot options, how you can use your Two-Pot options better in terms of planning for your retirement. And now we're going to talk about annuities. And I loved the way that Tsebo defined it. Annuities are how you can then pay yourself when your employer is no longer paying you. And to unpack this further, we've got from Momentum Corporate, Lynette Uys. Lynette, welcome.
Thank you so much. I'm really happy to be here. And we need to remember we only retire once. So this is a very important discussion to have.
It's very, very important because we think we're going to plan for our retirement when we get to retiring. But from these conversations that we've been having, you need to plan for your retirement from when you start working so that you know actually that I've made the right decision so that when I get to retirement, I can retire comfortably. Let's talk about annuities. Now, I've got what's called an RA, a retirement annuity, and from these conversations, I've learned that that's not the annuity we're talking about today because you're building up towards being able to have an annuity. But let's define it.
So an annuity is a retirement income.
Okay.
Income that you get at retirement.
Okay.
It is something that you choose because there's choices involved when you get to retirement age. And you have a choice on the type of annuity that you want, but that would be your retirement income. In the olden days, people spoke about their pension every month. They get their pension every month. So we are talking about an annuity every month, which is your retirement income.
So it's what's actually now coming to you as your retirement salary, so to speak.
Yes.
Okay.
Yes.
So you said it's a choice. There are choices to be made about your annuity. When do you start making these choices before we get to what the choices actually are?
Okay. You actually start from day one. When you start working, it's one of the important things to remember is the more you save, the better off you are. And I mean, we've seen it with all the discussions in the previous episodes. But just to give you a figure, to replace, hopefully, possibly, 75% of your last income, you actually need to save 15% of your contribution, your income, every month over a period of 30 to 40 years.
Because it's supposed to last you how long after you retire?
You might have to pay yourself a retirement income for a third of your lifetime. So just think about it. If you're 60 years old, what are the chances that you are going to get to the age of 90?
Yeah.
At this stage?
Yeah.
It's a possibility.
Yeah.
And looking at 15% of your income after tax and costs and fees and everything, that might not even be enough. So definitely, the more you can save, the better off you could possibly be at the age of 60 or 65 when you retire. But you need to remember, it's such a critical decision to make the right choice for you.
So these are the choices that you are making along your employment journey, right? So let's say you make all the right choices to be part of the 6% that retires comfortably when retirement age comes, and you are now actually now faced with the options that you have for your retirement annuity. First of all, when are you starting to think about this in terms of now the actual retirement itself? Is it 6 months before your last day at work? Is it a year before your last day at work, in terms of making these other decisions now?
So I think it's really important. We have found that when you start thinking about it 12 months at least before retirement, you start focusing and thinking about where are you going to go? What choice are you going to make? That's really a good time. So part of what we do as the Retirement Benefit Counsellors for Momentum Corporate and being part of Member Solutions, we do start contacting people way before that, but really focusing the last 12 months to have those discussions, to give the options, to show them what are all the possibilities that is available to them. Because as I said, I mean, you retire once in your life. It's a critical decision, critical time in your life.
I think what's scary is knowing that at some point your financial behavior is going to catch up with you, but it's going to catch up with you when there's very little that you can then do about it to reverse the situation. And you are now at this point where you're making these decisions about your retirement annuity itself now, and you're like, shucks, okay, it's facing me now. Because now you've got to make a choice between the type of annuity that you're going to have.
Yes.
Yeah.
Yes. Very important. If you've done all the right things, if you've saved at least the 15%, but not just that, you did that extra savings. You can literally, to have a tax rebate, save up to 27.5% of your income monthly towards your retirement.
So, if I'm understanding you correctly, you don't just need to pay the minimum. That is your minimum contribution. You can go above your minimum contribution. So let's talk about going above your minimum contribution. How little? What's the base? What's the minimum that you can pay extra?
The minimum, in terms of if you are already at the point where you are contributing 27.5%, but even if you don't want to do the percentage, the minimum that you can do as an additional voluntary contribution is 100 Rand a month.
Okay.
So, but you need to think about these things and look at it in terms of your budget. Can you afford it? Just take away the 2 extra coffees you buy a month, then you have 100 Rand.
Yeah.
So it's just one of the nuggets that I know we have spoken about in the series, but it's so critical at the end of the day, because when you get to retirement, you actually need to be debt free. The assumption that I gave you, the percentage of 15% less costs and fees, actually take into consideration that you don't have any debt. You have a paid off house, paid off car, everything.
Yeah, but
and then,
Lynette, I'm thinking I'm going to pay for all of that with my retirement lump sum. That's what we think.
That is what we think. And I think one of the most important things that happened throughout the industry is retirement benefit counsellors being there, educating people, giving them information, explaining to them how important it is to live a debt-free life, how important it is to save as much as possible, to make sure that you can be comfortable when you are at retirement age. I mean, we have, you said the figure, 6% of working South Africans can retire comfortably. 94% of the working South Africans can't. Imagine having to work until the day you die, not because of choice, but because you have to. You don't have an income that can support your life.
Phew, okay, let's create retirement-topia, okay?
Retirement-topia, I love that.
So we've done everything correctly. You've gotten rid of your debt. We've spoken about this with Sipho in terms of the two-part options, and you've exercised that very carefully, and you've looked at everything, whether you started working on the 1st of September 2024 or whether you started working prior and all the changes came into effect and you got all the right advice and you made all the right decisions and you've saved, like Tsepo has really encouraged us to do. Biki Mark Meer.
Yes.
You haven't bought coffee at the office. You've done your additional voluntary contributions, and you are now 12 months away.
Okay.
And you've gotten that call, and you now need to make decisions about your retirement annuity. What choices are you faced with?
So there's two basic choices.
Okay.
Everywhere. The one is a guaranteed life annuity. The other one is a living annuity.
Okay.
Let's just talk about the guaranteed life annuity. One step back, when you do get to that point, you are allowed to take some money in cash. You know, you've been paying towards your retirement, so there is a 550,000 tax-free portion that you can take at retirement. Okay, so you take that into consideration. 550,000, you take tax-free. If you've had a pension fund, you can take one third as cash. Obviously, you get tax-free portion, and the rest you pay tax for. And then you have the 2/3 that you need to purchase an annuity, or you use everything to purchase your annuity.
So Lynette, let me get this right. Purchasing an annuity. So what you've been saving all along with your additional voluntary contributions and your minimum contributions and your 27.5%, all that is what you're going to use to purchase an annuity.
Yes.
So you don't have an annuity until you get to the point of retirement. Yes. So all this money is now going to buy you the rest of your 30 years.
You spoke about a retirement annuity. That's a savings vehicle. So that's one of your savings vehicles.
Okay.
A RA.
Okay.
People talk about it as an RA. It's a retirement annuity. One of the things that you are going to use to purchase your annuity. So that's guaranteed life annuity, living annuity.
Okay.
So let's unpack a guaranteed life annuity.
Okay.
So a life annuity is, and annuity choices are different for different people. It depends on what your needs are, etc. So it's very difficult to put figures to it. But what a guaranteed annuity would give you is a guaranteed income until the day you die, even if you live until you're 100 years old, which is 40 years longer than a third of your lifetime when you retire at 60. So you are guaranteed an income. If you have a spouse, you can include them in a joint life.
Okay.
So if you pass away, your spouse will continue to receive the annuity until they pass away. And then the other option is to actually take a guaranteed term.
Okay.
And that term is not dependent on you being alive. So let's say you take a 10-year guarantee term, you and your spouse passes away in year 5, there's 5 years left that this annuity will continue to pay your beneficiaries.
This is quite important. Yes, we are told make sure that your beneficiaries are updated, all your documentation is up to date, but this actually becomes even more important. Well, let me not say it becomes even more important. It emphasizes the importance of that, because let's say you've made that decision to take that guaranteed annuity and your documentation is not updated. Then, so the point that I'm getting at is it's all these little decisions that build up to whether things really work out the way that you wanted them to when you were employed. But you're still saying?
So really important, just to get back to that beneficiary nomination. Luckily, it won't go past us without one.
Okay.
To before they implement the annuity.
Okay.
So that's really important. So somebody that is really focused on making sure that they do not depend on anybody until the day they die, a guaranteed life annuity might be a good choice.
Okay.
But everybody is different.
Okay.
Now, on the other hand, you have the living annuity. Just one back. The guaranteed annuity, the life annuity.
Right.
The risk becomes the insurer's risk. So if you purchase That annuity with momentum takes the risk
Okay.
of you living until you're 100 years old,
Okay.
and they having to continue paying you.
Right.
Okay, so the risk is with them. Okay, on to a living annuity. A living annuity, you have choices.
Okay.
It's sort of like an investment account. That's sometimes how I explain it to myself. It's like an investment account. It's my account. If you think about it that way, and you can choose your drawdown rate. Now that's your income, retirement income rate. It can be anything between 2.5% and 17.5%. Your choice.
Okay.
Your investment portfolios. Your choice. As I said, your choice, your risk. But what happens in terms of a living annuity, you can review it on an annual basis.
So the decision I made in 2025, I'm not stuck with it.
No.
I can.
In 2026, you can review your income percentage. You can review your portfolio that you invested in. That's such a great question because there's so many choices and you only do it once. So the first thing that you have to think about is, are you going to take a cash portion?
Okay.
So cash portion, if you did everything right, you preserved, you never took your retirement monies, you can take 550,000 as a cash-free lump sum.
Do I have to take a cash portion?
No.
Aha.
No. So the 550,000 is tax-free.
Okay.
But you can take up to a third if you have a pension fund.
Okay.
But then there are two options.
Okay.
Basic options. There's combination of these options. But let's just talk about the basics because we want to understand how annuities work. So you referred to a retirement annuity earlier.
Right.
That is a savings vehicle.
So the retirement annuity that I have while I'm still working that I'm contributing into is not the same as an annuity at retirement age.
No.
Okay.
Okay. So an annuity is basically, remember we spoke about this in terms of it's your retirement income. Now, the choice lies between a guaranteed life annuity, so we call it a life annuity, or a living annuity.
Okay.
And it depends on your needs. So when we look at the guaranteed life annuity, it gives you a retirement income that is guaranteed for your whole life. The risk goes to the insurer because they are insuring you of an income, retirement income, until the day that you die. If you're married, you can actually include your spouse in a joint life. So if you pass away, your spouse will receive the annuity until the day that they pass away. If you want to, you can also include a guaranteed term, which would mean there's a certain term that there's a guaranteed payout in terms of the income. And if you and your spouse passes away before that period has expired, the beneficiaries will receive the income until the period is over.
And that's the importance of ensuring that your beneficiary information is up to date.
Your beneficiary nominations during the course of your life, saving in the retirement vehicles, very important. Beneficiaries, when you choose a retirement income option, it is important because if you choose a guaranteed term, there must be somebody that would be able to receive the money. But if that guaranteed term is passed, you will still receive your guaranteed income. So that has nothing to do with your income.
Okay.
It just has to do with if you pass away within a certain period, there should be somebody receiving the money because the momentum has given a guarantee that it will be paid for that amount of time. Now that's the life annuity, guaranteed life annuity.
Okay.
Then the second option that we have is the living annuity. Now living annuity is it gives you a lot more choice. So you choose you can choose your income percentage. So your living annuity is like an investment account because it's your account. Your living annuity account, as long as there's money in, you will receive an income.
So this is the money remaining after if you choose to take a lump sum.
Yes.
That then becomes your living annuity.
So you buy an annuity with your retirement monies. Okay. So you have this annuity account. You can choose your income, your retirement income percentage being anything between 2.5% and 17.5%
of that annuity that you've purchased.
Annuity account, and you can choose your investment portfolios.
Okay.
When I say choose, you can choose, you can choose.
Oh, so while the money, when you're taking the between 2 and 17%, what's remaining, you're investing?
It stays invested, yes.
Oh!
So it's your choice.
Okay.
Everything is your choice, but the risk is also with you.
Okay.
So the insurer is not taking the risk because you are on the market. Okay, so that's the living annuity. A lot of the risks on you. But you get to review your income percentage and your investment portfolio on an annual basis.
Okay.
So you can choose to make a change on an annual basis. So that's where you keep on having choice on your side.
And how do I come to making those choices, or how do I go about it? Not how do I come to it? How do I go about it? So let's say I need to review it in August 2025. What's the process involved there? Do I just, a lot of things are automated these days. No. What's the process?
Okay, nothing in terms of your review is automated.
Okay.
So you do have to actually choose an option to make a change.
Okay.
It could happen that you're quite happy with what you have,
right,
and what you're receiving, and you're happy. You don't have to make a change. It's your choice. So you can make a change. You will get the information to actually make that change yourself. Always a good idea to have somebody with financial background helping you in the process of making the right choices. So really important. Have a discussion with a retirement benefit counsellor. Have a discussion with a financial advisor. And those are things that you can start with a lot earlier on in your life and actually build a relationship, because you need somebody to trust to make financial decisions. This is not just something that you do on a whim. Remember, once. You retire once.
So when I'm making all these decisions, the recommendation is that I consult with a financial advisor and a retirement benefit counsellor. And that is so reassuring, because we think financial advisor is for people with lots of money. Because if you were to say to me, I must go to a financial advisor, I would say, with what? For what? What am I going? What?
Yeah.
Because we think if you're just living your normal day-to-day life without these huge sums of cash, you think that because you just have your income and you need to pay your bond and you need to pay your medical aid and you need to pay this, that, and the other, your normal expenses, you figure as long as I've paid my bills, I'm fine. And you don't stop to consider that financial advice helps you manage that basic, inflow and outflow of your monthly salary better. We just think it's for people with large sums of cash. And I think as you get older and you're faced with different scenarios and different demands and different, just contexts of life has changed. You're not working anymore. Maybe you've got a child that's still dependent on you that you thought would have already left home. And, you're faced with those decisions now, and to sit there by yourself in your olden days, and you just, let me say olden days, in your golden years, and you're making all these decisions, I think it would be quite daunting.
Yes, it is daunting. We have numerous pre-retirees just before retirement, the 6 months, 3 months before retirement, they realize they don't have enough, or they they might be able to make it. But there's so many things that you need to take into consideration. And talking to a benefit counsellor from the word go. So we really want even the new starters to talk to us, because then step by step we can go through this process and give them the information that makes them, that helps them to make financial sound decisions as they go along. And having a financial advisor could possibly help you make better decisions in terms of the portfolio that you are invested in whilst you're saving for your retirement. They can look at the portfolios, help you manage that. They can look at helping you to maximize your savings and maximize the tax rebates that you get, because they work with it. And just on a sideline note, I've been doing a lot of webinars about retirement, and I once had a question, and I asked my dad. My dad is 88 years old. He was always focused on retirement, so it makes me like, the work that I do is like, retirement planning, those are things that I grew up with. And I asked him a question. I said to him, Daddy, what would you have told your 30-year-old self? And his answer was that he would have told him to save more, and he was saving a lot. We did not drive the nice cars. We had the, he would have told himself to save more, to educate himself or get educated about investments and better financial choices, etc. So this is a man that really focused on retirement and saving for retirement. I mean, I grew up with it. It's something that I'm used to. I'm in the perfect job because this is something I learned from a little child. And even him would have told his 30-year-old self, hey, understand your finances, understand what you're doing. So you're never too young to learn, to save for your retirement, and to understand what your options are going to be at the end of the day.
So Lynette, when we were talking about the additional voluntary contributions, and we were talking about the minimum contributions in terms of how much money you put towards your savings that you will use to buy your retirement annuity with, we talked just briefly about the tax benefit of that. Are there tax implications besides the lump sum that you take at the end of your working life when you're starting your retirement? If you choose to take that lump sum and there's a cap that is tax-free below that cap, are there tax implications in terms of which annuity you're taking and how you exercise that annuity?
Unfortunately, we pay tax.
Even after retirement?
Yes, even after retirement. So it depends on what the purchase amount is that you purchase your annuity with.
Okay.
So you will get your tax rebate on your retirement annuity, which is the vehicle. But when you get to retirement and you choose your annuity that would give you your retirement income, you still have tax to pay. But as you get older and older, the less it becomes. But you start out, and you would know that if you ask a retirement benefit counsellor or a financial advisor to actually give you a quote on, the options, you would know exactly, and you should ask the question, how much tax am I paying? What are the fees that I'm paying? What are the costs? Everything, so that you can make an informed decision. But yes, tax, you will be paying tax. I really have to clarify the tax part. It is so confusing for everybody. So let's talk before retirement and then after retirement.
Okay.
So I think I always get a little bit confused, and I just want to make sure that everybody understands. So before retirement, when you are paying towards your provident or your pension fund, and say your contribution is 1,000 Rand.
So this is the amount that I'm paying every month.
Contribution towards your retirement fund.
Okay.
So that's your pension, your provident fund. So that contribution is taken out before you are taxed.
Okay.
That's where the tax rebate comes in for the 27.5%.
Aha.
You know,
Okay.
taking the steps, step by step, saving for retirement.
Okay. Okay.
Now, at retirement, we make the choice, we can take a cash lump sum. We said 550,000 can be tax-free.
Okay.
But that's only allowed once in your life.
Aha.
So if you didn't do the right things, as we were saying, saving and preserving and not taking any money when you change jobs, then you would have 550,000 Rand tax-free that you can take as a cash lump sum. But you can take up to a third in terms of pension fund. But there's a lot of complicated discussions to have and calculations to have at that stage. But whatever is left of that retirement savings, you are going to use to purchase, to buy your annuity income choice. So that's the guaranteed or the living annuity. That part you do not pay tax on. It moves right into your annuity fund without you being taxed on that.
Okay. So let's do the maths again. Contributions taken out before tax on my salary is deducted.
Yes.
Okay. Then I can take up to 550,000 when I'm now retiring. I can take that lump sum, and up to 550,000, there's no tax on that. But I don't only need to take that amount. I can take more, but we're focusing on tax now. So we're looking at the good news of tax. We don't want to pay tax. Okay. And now, whatever is left now, if you've taken whatever portion you've taken as a lump sum, whatever is left then moves to now buy the vehicle that you choose. We talked about it, guaranteed life and living. That money that moves to buy that moves without being taxed.
Yes.
Okay.
Okay. And then we get to the point where you are now getting an income from the vehicle that you chose.
Okay.
That when the money is paid into your bank account, money moves out into your bank account, you get taxed. That's where the tax lies. But remember, as you get older, your tax percentage also decreases. So you're not going to be that high flyer that you are now, paying the highest tax. You will get that a lower tax rate as you go along, as you get older.
But Lynette, just as we end our conversation, I think what's been so important in this conversation, and which is a common thread through all the conversations that we've had, is the importance of actually having a plan, having a strategy for your retirement, which means you mustn't think it's too early. Because, you know, the bad financial decisions, I'm not saying that they don't happen when you're older, but they happen when you're younger. And then you're finding yourself, now you're in credit bureau, you're in all these things because of all these mistakes that happen when you're younger. But if you bear this in mind, that it might seem like it's far. You're only 25, you're only 30, you're only 35, it's getting closer and closer. But then your responsibilities are also increasing. And so any mistakes that you make reach beyond you. And, you know, there's something that Tsepo said in the other conversation that we had, was that you then find yourself then being looked after because you haven't planned properly. And that's now creating a situation that extends beyond you because of these decisions that you've made. And that's quite important. But also you keep on saying, get the right advice. Get the right advice. At every point, at every decision, get the right advice, because the terminology can be quite confusing and it can be quite daunting. And I think because retirement is such a big shift, you know, I was watching a thing the other day where the person said, I was prepared for retirement, but I wasn't prepared for not having anything to do. I was not prepared for not, and all of that can work a number on you. And you're now sitting with the emotional experience of retiring, and you now have to live the financial experience of retiring. And emotions and money sometimes can, so I think that's all quite important, and that's been very important in this conversation. So thank you very much for sharing all this information, and everybody, please remember, get the right advice.
I would like to end just by saying, if you fail to plan, you plan to fail. Benjamin Franklin said that many, many years ago. And you're never too young to have a conversation with a retirement benefit counsellor. It costs you nothing, but we have a lot of information to share. And it is all throughout the country, throughout all the whole of the industry. Please just talk to somebody. We all make mistakes, but we can learn from them. And thank you for having me. I really, really enjoyed spending time with you.
Thank you, Lynette.
Thank you for joining us on this episode of the podcast. Remember, you can like the episode and share the podcast link, as well as listen to more episodes on the channel. Subscribe to the channel for more. Siyabonga. Thank you for listening.